Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Cava stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 13.5 billion market cap. They're trading at 118 a share, and they have 114 million shares outstanding. Cava owns and operates a chain of restaurants under the Cava brand. It also offers dips, spreads, and dressings through grocery stores. In addition, the company provides online and mobile ordering platforms. It was founded in 2006, headquartered in Washington, D.C. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had negative free cash flow up through 2023. They finally had positive free cash flow in the trailing 12 months, positive 44 million. And they convert 5% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 21 and 22, a small positive in 2023. It did grow 300% to 54 million. That's in the trailing 12 months. Margin 6%. That means they convert 6% of their revenue into net income. Revenue is a sales for the company, and that grows each year from 500 million to over 900 million. Nice, steady, consistent growth. We estimated 4 years of future free cash flows. We also estimated the terminal value of total cash flows past year 4, that's 9.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We got a value of the company of $8 billion. We divide that by 114 million shares. And we get a calculated stock price of $69. They're trading at 118, so they're trading at a 70% premium. It's a sell according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 67 companies in the same industry as Cava, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They only spend 112 million in CapEx. Starbucks spends the most, 2.8 billion. It's pretty amazing that McDonald's is close to Starbucks because Starbucks owns all their stores. McDonald's doesn't own any stores. All their restaurants are franchised out. The franchisee is responsible for all the expenses and running the day-to-day business. That's why McDonald's is so much more profitable than Starbucks, because Starbucks has more revenue, about 40% more than McDonald's, but half the free cash flow, because McDonald's collects lots of royalties. That's how they generate profits. They also make quite a bit of money on real estate, but the main business is the royalties. Starbucks doesn't collect royalties. It has to work really hard for each dollar of revenue. They have a good debt to equity ratio of 0.6 for every dollar of equity, 60 cents of debt. They don't pay a dividend. Bloomin' Brands pays the highest, 5.7%. They generate 44 million of free cash flow, much lower than McDonald's, Texas Roadhouse, Wingstop, and Brinker. And those companies are smaller in market cap. Actually, Domino's is a little bigger. Cava is much smaller than McDonald's and Starbucks. McDonald's is the largest by far, over 200 billion. Starbucks is a little over 100 billion. And Cava looks really overvalued according to their price multiples. A 250 PE ratio, 309 price of free cash flow ratio. They generate 900 million of revenue, a lot lower than the top 7 companies. Also a lot lower than most of the other companies behind it. They have not been public 5 years, so we can't look at their 5-year annual revenue growth rate. And their 52-week low was $44. It nearly tripled from the 52-week low. It is down 22% from the 52-week high, but up 169% from the 52-week low. I never even heard of Brinker, but they're up 275% from their 52-week low. They're trading at their 52-week high. So is Dutch Brothers. If you put $10,000 into this company when they started trading, you'd be at $31,000 today, a 100% annual return. So it's been trading a little less than 2 years, and it doubles each year. So the stock has been trading about 19 months or so, and it's done really well. Actually, after a few months, it was down. Then it just blew up since the bottom. So from top to bottom, you could have turned 10,000 into like 40,000. But even if you bought at IPO, you're still doing pretty well. So to summarize, I have them trading at a 70% premium, ranking 5 out of 10. It looks like it's a bit inflated, so would I buy it short term, 4 out of 10? Long term, I think it's a good value, 7 out of 10. Ratios look terrible, really overvalued. So that's 1 out of 10. Financials look real good. Revenue up 83% since 2021, and they finally have positive free cash flow. Let's take a look at their income statement. Here's the 3 months ending 10/1/2023 compared to the 3 months ending 10/6/2024. Revenue up quite a bit from 176 million to 244 million. Let's see if they give a breakdown of the revenue. The only breakdown they give is restaurant revenue, 242 million, CPG revenue, 2.3 million. CPG stands for consumer packaged goods. And they have a little blurb down here. Revenue from the redemption of gift cards and loyalty program is part of restaurant revenue. In October, they launched the Reimagine loyalty program. The goal was to develop personal relationships with their guests. So you earn points every time you go there, and then you can redeem the points for food or beverages or possibly merch. This income statement has percentages, so let's look at that. Below revenues, operating expenses 74 million, which is 30% of their revenue. That's their biggest expense. Labor 61 million, 1/4 of the revenue. Occupancy, like rent, that's 7%. Other 30 million, 12%. So operating expenses 74% of their revenue, which means their operating income is about 26%, which is pretty similar to last year. Then below that is G&A, general and administrative expenses, 30 million, which is 12% of their revenue. Depreciation 14 million, 6%. So their total operating expense is 230 million, which is 94% of their revenue. Their operating income, which is revenue minus operating expenses, 14 million. Operating margin 5.6%, a lot higher than last year of 1.6%. They receive 4 million of interest income, so their pre-tax income is higher than their operating income. Pre-tax income 18 million. So their pre-tax margin 7%, last year 4%. And they had a tax benefit of 57 million. So their net income is a little higher than their pre-tax income. Net income 18 million or 7% margin. They give a little more info down here. The increase in revenue was driven by a $68 million increase in their Cava segment. That's their restaurants. Here's a breakdown of the restaurant revenue, which was 241 million. It was mainly due to a $38 million increase from their 73 new restaurants. So the net new restaurants is 73. For example, they may have closed 7 stores and open up 80. That's how they get a net 73. They also had an 18% increase in same-store sales. That was 13% from guest traffic and a 5% increase from menu prices and the different products people buy. So the gross profit on the restaurants is 62 million, which gives them gross margin 25.6%, higher than last year of 25.1%. Here's a breakdown of CPG, the 2.3 million of revenue. The expenses tied to that 2.3 million is 1.3 million, which is food, beverage, and packaging. And then other is 180,000. And they mentioned the increase in revenue was mainly due to increased sales from dips, spreads, and dressings, because they sell those products in grocery stores. This is not tied to their restaurants. Let's look at their balance sheet. Their current assets, 393 million. Current liabilities, 134 million. So current ratio, about a 3. Lots of cash, 367 million. Accounts receivable, 6.5 million. This is how much money's owed to them. Other accounts receivable, 6.7 million. This is also owed to them. So when I Google what is other accounts receivables, this is what they say. It could include interest receivables. That's the interest they're owed on the debt they issued. Salary receivables, employee advances, tax refunds, loans made to employees or other companies. It's really dependent on the company, especially if you compare 2 companies in different industries. It could be totally different. Let's go back to the balance sheet. Inventory, 7.3 million. Prepaid expenses, 5.6 million. This is when a company makes an advance payment for a product or service they're going to receive in the future. Then the non-current liabilities. Their big one is property and equipment, 360 million. They do give a breakdown of this. The gross value is 544 million. That consists of leasehold improvements, 315 million. Equipment, 104 million. Computer hardware and software, 51 million. And some other things. They depreciated 181 million, so the book value is 363 million. They do define construction in progress. That includes Cava new restaurant openings and technology improvements, Building includes the new production facility in Virginia, which commenced operations in the first quarter of 24. So they have a facility in Virginia that they make a lot of food. They prepare the food and ship it to the stores. Operating leases, $314 million. These are assets another company owns, but they lease those assets. Not much goodwill, only $2 million. Goodwill is the premium you pay when you acquire another company. Accounts payable, this is how much money they owe when they buy on credit, $25 million. Accrued expenses, $68 million. And they give a breakdown of the accrued expenses. $29 million is accrued payroll and payroll taxes. This is how much money they owe their employees. Accrued capital purchases, $60 million. Sales and use tax payable, $6.1 million. Because every time they sell food and drinks to customers, they have to pay sales tax on that. Every month, they pay sales tax to the state they're in. So if they have stores in New York, they have to pay sales tax in New York. If they have restaurants in Texas, they have to pay sales tax to the government in Texas. And $4.5 million of gift card and loyalty liabilities. When somebody buys a gift card, that's a liability for this company. They just lumped in other at $22 million. They have a lot more operating lease liabilities, $328 million. This $328 million is due beyond 12 months. This $41 million is due within 12 months. Assets minus liabilities equals equity, $616 million of equity. They raised $1 billion from selling their business, selling stock, and they lost $400 million from running their business. Accumulated deficit is an accumulation of their net income since they started as a company. If you search this number, the $395 million, you'll find it in this report, the statement of stockholders' equity. So a year ago, they had accumulated deficit of $456 million. They had a gain in net income of $6.8 million, so it improved to $449 million. They don't show what happened between 10/1/23 and 7/14/24. They just jumped to 7/14. It was negative $413 million. They had net income of $18 million, so it improved again. So it looks like maybe in a year or two, they'll have positive retained earnings instead of accumulated deficit. Let's look at a statement of cash flows. The first section is operating cash flow. The way you calculate operating cash flow, you start with your net income, $52 million. Then you add back the non-cash items on the income statement. Depreciation, $45 million. That's usually the largest non-cash item. Unless it's a startup, then usually it's stock-based compensation. Theirs is only $9.9 million. Then you adjust for changes in working capital. The biggest change was a cash outflow of $25 million from operating lease assets. The biggest inflow was $34 million from operating lease liabilities. So cash flow looks pretty good, $131 million. Last year was $73 million. The only thing in their investing section was PP&E. When they open a restaurant, they buy a lot of equipment. They might even buy the real estate or the land. That's all part of PP&E. Last year was more, $108 million. In their financing section, they had a cash outflow of $16 million. Last year, a cash inflow of $335 million. The main thing in 2024 was a cash outflow of $18 million from equity awards. So when they give stock to their employees, it doesn't cost them anything, the actual stock, but they do have to pay taxes on that stock. So this is the taxes they paid. Last year, they had a big cash inflow, $340 million from issuing stock. And when you issue stock, you have to pay fees. And when you issue stock, you have to pay fees to the investment bank, like JP Morgan or Goldman, whoever the investment bank was. They pay $23 million of fees. So the cash at the end of the period, $367 million, which matches the balance sheet. Right here, $367 million. That's how the balance sheet and statement of cash flows are connected. Let's take a look at the company on Simply Wall Street. Its last price, $123, $14 billion market cap, up 7% in the past week. Look at this, up 158% in the past year. It looks like they started trading in June 2023 at around $40 a share. 1 month later, it hit 57, but then it came down to its all-time low, 31 in October of 2023. It had a really nice run-up from that point up until November 2024. It hit almost 150. It has struggled a bit. It looks like people are selling off their stock, taking in their gains. And it came down to 112. Now it's up a little bit from that low point at 123. Simply Wall Street's valuation is 98. They say the stock is 25% overvalued. 13 analysts priced this stock at 150. They say it's 21% undervalued. Here's their revenue since 2021. It was $500 million. It almost doubled. It's $913 million in the trailing 12 months. So pretty good revenue growth. They only had $15 million of debt in 2021. They paid it off. Usually when a company goes public, they pay off debt. or they may use the money to expand, maybe acquire another company, open up more factories. But they had such little debt, so it wasn't hard to pay it off. And they've been debt-free since then. Equity looks good, $269 million in 2021, now it's $616 million. And more than half their equity is cash, $367 million of cash. The CEO's salary is $600,000. Total compensation $17 million, tenure as CEO 15 years. In the past year, only insider selling, no buying. George Costanza's cousin, Kelly Costanza, she sold 7,600 shares. And you can see it's a pretty long list, lots of sales. 8 million shares sold, 6 million, 2.5 million, 3 million, 2 million, 1.5 million, 3.5 million. Here's a more high-level view of shares sold. This is by quarter. In the last quarter, 9.5 million. Before that, 7 million, 5.7 million, and 7 million. 62% of the company is owned by institutions, 27% by the general public, 8% by VC and private equity firms, and 2% by insiders. Artel Group is the biggest shareholder at 8%, then Vanguard Capital Research. Fidelity owns 3%, Renaissance 1.5%, Federated Hermes almost 1%, and to bottom out the list, TriHouse 0.6%. Their employee count went from 6,900 in 2022 to 8,100 currently, and the ticker trades on the New York Stock Exchange. So if you want to get a copy of my DCF model, click on the video in the top right corner. Thanks for watching.